Hey, what's up, guys? I put together a quick presentation going over the temporary 2-1 interest rate buy down, also just known as a 2-1 buy down. You might have heard of it before. It's not brand new, but it just wasn't super popular when we had historic low interest rates. Wasn't really a need for it and wasn't really being offered. Now that interest rates have spiked quite a bit, I'm sure you're well aware, this has become much more popular and desired for buyers and sellers across the country. So I don't want to take too much time. I just kind of want to get into it and just give you a rough idea and just a better understanding how this works and whether or not this can be advantageous for you. Now, it's important to know not every bank, not every lender offers this product. So, ask your real estate agent, ask your loan officer, mortgage advisor, if this is something that would be available to you. So the way that it works is, to give you a quick kind of example, would be, let's say today's interest rates for a 30-year fixed rate mortgage is 6.5%. With the 2-1 buy down, that first year, your first 12 months of mortgage payments, your rate's going to actually be discounted by 2 full percentage points. So instead of 6.5, it's going to be 4.5. Okay. And then the second year, so the next 12 months, it's discounted by one full percentage point. So instead of the 6.5, it's 5.5. And then the remaining years, 3 to 30, is going to be that 6.5 interest rate, assuming you keep that term, which I doubt it, but that's how it would work. It's not an adjustable rate mortgage. You just have a discounted rate for years 1 and 2, and the remaining term is fixed at that at that agreed upon note rate when you lock your interest rate in. Okay, so who would be eligible? What property types? How does that all work? So it does have to be for primary or secondary home purchases, right? So we're talking about conventional loans and FHA and VA purchases. So those are the loan types and property types that would be eligible. So investment properties, unfortunately, as of right now, would not be eligible for the 2-1 buy down. Now, a couple things to note before I actually show you a real kind of life example in the calculator that I have, so you can see how it would work in practice. I want to make sure we kind of understand these 3 things. First, the one kind of added layer of protection is you still have to qualify for the monthly payment on the note rate, not the discounted rate. So again, if today's rate is 6.5, you have to qualify at that interest rate or at that monthly payment. So like I said, that's an added layer of protection. You're not kind of squeaking in and qualifying for a discounted rate, because that's not going to be your actual rate or actual payment long-term, right? Additionally, the funds, so it's not free, right? In order to buy down your rate at a discount for 2 percentage points year 1, 1 percentage point year 2, it's going to come at a cost, right? But that cost, it has to come from the seller. So a seller assist or seller concession. All right. And we'll talk about that a little bit more, how that's calculated and how that would actually look and work in a real kind of scenario. Another thing to note, and you'll see why I mentioned this, is if you refinance within the first 2 years, the remaining subsidy is applied to your outstanding principal balance. So just remember that. I'll refer back to it. But let's kind of jump into the calculator here. So here we go. If you see this, I'll move myself out here. Okay. So here's an example. Let's say the purchase price is $500,000, right? You're putting 10% down, or $50,000. Your loan amount is going to be $450,000. Now let's keep with that running example that if today's rate is 6.5, okay, and you have a 30-year loan, your principal and interest payment would be $2,844. Okay. Now, if you did the 2-1 buy down, like I said, year 1's 4.5. Now that monthly payment is significantly less at $2,280, which is $564 less a month, which equates to over 12 months, almost $6,800. Year 2, we're at 5.5 monthly payments, almost $300 less. So on an annual basis, that's going to be almost $3,500, right? So you can already see the significant savings that you would have over the first 2 years. So where does that money come from? How would you qualify? So you see right here, total savings, 10,241. That's just a total of this, right? In years 1 and 2, how much you would save. That's how much the seller assist or seller concession would have to be. So the seller concession has to equate to your total savings during the buy down period. Okay. So you basically run the numbers, you put the numbers in the calculator, and if you know what the purchase price is, or what you're offering, what you're offering, what your loan amount would be, this is how much would have to come from the seller. All right, in order to make this work. Now, the cool thing is, now what if you refinance after the first 12 months? Because interest rates maybe come down, the market's improved, and you determine it'd be a good opportunity to lock in your interest rate at, let's say 5%, or, in the high fours for 30 years locked in, because coming in year 3, your rate's going to jump to 6.5 for the remaining term. So you decided, I'd rather lock in this interest rate at, like I said, high fours, 5% for 30 years, kind of get that level of comfort knowing that it's not going to change. The cool thing is, if we refer back to this slide, if you refinance in the first 2 years, the remaining subsidy is applied to your outstanding principal balance. So that money doesn't just go away. It's not a sunk cost. You're still getting the benefit. So what happens is, let's say after year 1, you kind of basically exhausted $6,700 in year 1, right? So this $3,470 is what's remaining in that, account. Let's say that money would get directly applied to your outstanding loan amount at that time. So I think it's a really cool feature. So it's not just like you refinance and that remaining savings that you thought you were going to get goes away. It's going directly towards your principal. So to me, I think that's very advantageous. I might have been a little more hesitant if, in that first year you refinance and there's additional savings you thought you were going to get up front when you agreed to this deal, would just kind of go into, a black hole. I would understand, but being that, worst case scenario, you're going to get these savings, or whatever happens, or whenever you refinance, the outstanding balance is going to get directly applied to your principal. So it's a really cool feature. The program in general is really interesting, and I think ultimately is going to be a great strategy for buyers and sellers around the country. So from a buyer's perspective, we see why this would make sense, or we see why this would be interested, or why they would be interested. From a seller, you're like, oh, well, why would I want to give this money away off my bottom line and, net less from my home sale? Well, it's not for everybody, right? But it's for some homes maybe they've been sitting on the market, or maybe you're seeing price reductions. So instead of continuing to reduce the price and it just becoming like a stale listing, what they can do is, or what that listing agent can do, is basically advertise this, right? They can say, hey, the seller is willing to give a seller concession of X in order to give any prospective buyer a discounted interest rate. So now it's a win-win, right? So that's how it can really benefit both buyers and sellers. So now that we're seeing homes stay on the market a little bit longer, we're not seeing a crazy bidding war on every single listing. This is where this specific strategy can really help both the buyer and seller and create a win-win scenario. So I hope this made sense. Hopefully it wasn't too confusing. It's my first time doing a screen share record, so hopefully this turned out okay. Any questions, feel free to shoot me DM, reach out on any kind of social media platform, or directly on my cell, email, whatever. Hope you found some value and hope this made sense. Thanks.